Good day, everyone, and welcome to a session on how tech stocks could be interesting and attractive for both growth and income investors. Now, the way we're going to run this session is I will cover the first part, which is really the portfolio construction aspect of including tech stocks in your portfolio, where we've done a lot of research from the 1990s, which shows why they are an attractive option. The second part is where my colleague Olwethu Notshe will cover a case study in Texas Instruments, which brings this study to life. Now, firstly, why did we think of this topic? Tech stocks are often seen as high risk, high growth opportunities, and often value investors shy away from them. And therefore, as a result of that, you've often seen income investors veer away from them. Our view is that things have changed. Tech has changed a lot, especially recently in the last decade or so. And so we're going to show you why actually a lot of these things are fallacies or myths, and why including them makes a big difference to both your risk-adjusted return as well as the underlying fundamentals within the portfolio. So to begin with, I just want to clear up some issues with regards to Sentio, and we're not trying to sell the story of growth investing over here. We're essentially a style agnostic investor. So just a bit of a recap about our investment style, and that'll show you that a lot of this research is not just about us talking our book. Firstly, we have for the last 15 years been integrating bottom-up fundamental analysis with machine learning and quants. Now, the reason for that is we think humans with technology make better decisions. So, we don't think that machine learning is going to take over humans at any point in time from an investment perspective. But we think the way we integrate these technology tools into our toolbox allows us to make better decisions. We're style agnostic, as I said at the beginning. And what that means is we don't really care whether we have growth stocks in the portfolio, value stocks in the portfolio, quality stocks in the portfolio, but we are very conscious of what we do have. And the reason for that is there are times in this new world that we live in where certain styles don't work for a long time, and we know about that, for example, from the value style perspective. So our view is that we will have tilts when we see it necessary, as long as we have the cheap stocks relative to those styles. But we're agnostic as to whether we have more value or more growth over time. Generally, we haven't had a bias since inception in our portfolios, but at particular points in time, you might see those biases. Process is very important to us. We're technology and process driven. What that means is we're looking for consistent decision making. Consistent decision making allows you to circle back when you've made mistakes and reverse bad decisions. It also allows you to be more honest with yourself about whether you're being true to your investment philosophy or not. And so we're very strong on that. Finally, we are all about risk-adjusted returns. We're not about shooting for the ceiling and shooting the lights out and then eventually kind of having a year where everything falls apart. So you could say we benchmark cognizant. We have a high conviction style, but it's within a benchmark cognizant approach. So let's talk about tech stocks. But firstly, let's clear up some aspects of what makes a tech stock. There's really four key metrics that we look at. Firstly, tech stocks are somewhere in the value chain of solutions from a digital perspective. It doesn't have to be a Facebook or a Google or any of those. It can be anywhere in the supply chain of software or even hardware. And that's important, as you'll see. They generally have a long duration growth profile. What that means is in the early stages, you need to have a bit of a leap of faith in order to ensure that you kind of get in early. And this is the most difficult aspect, because often in the beginning, these stocks don't look like anything you'd see as a success factor initially. So they do require that leap of faith. The short-term cash flow profile is often not matching shorter-term valuations. Obviously, there are some exceptions, but this is also what makes many value investors afraid of buying these stocks, because they look expensive. And you'll see as we go ahead why that's not necessarily true. And finally, these stocks tend to be correlated to growth stocks. They tend to be negatively correlated then to value stocks. And so that's where you get this putting all tech stocks into the bucket of growth stocks, and that becomes an anti-value argument, which we don't agree with. So let's clear up some issues with regards to tech before we continue on why this should be something you have in your portfolio. Because tech has many faces. Firstly, let's answer the question, is tech expensive? And if you look at global technology and the PE relative of the MSCI technology versus MSCI world, what you see is actually it does trade at a premium to MSCI world. But as you'll see in a moment, at far higher returns on returns on assets. So what that means is, yes, on the face of it, if you're very simplistic about PEs, it is expensive. But once you start getting more sophisticated about why you buy these stocks, as you'll see in these charts, you can see that the return on assets of technology stocks have consistently been higher than the return on assets of MSCI World. Now, there might be some arguments around, for example, writing off of assets and the like. But that happens in most sectors in the early stages of introduction. So that's not necessarily anything new. And bear in mind, a lot of these assets include cash. So particularly from that perspective, the return on assets is very attractive. Next question, what are tech companies' fundamentals like? Are these decent businesses? And we've done some analyses from 1999 to 2022. And what you find is that on most metrics, tech stocks actually filter very well. They have better earnings growth and better dividend growth. And they also have better balance sheets with low levels of debt. Now, that basically is a quality bias. And that adds to the growth bias of tech stocks. And yes, there is some survivor bias here where, some companies in the early stages of the tech bubble, may not be around anymore. But once again, isn't that the job of an investment manager, to find the winners, the ones that will last? So from a fundamental perspective, global tech has actually got a very high quality aspect or style to it. What that means is you're not just getting growth. And this is where technology has changed a lot. So the next question then is tech more risky? Because this is something many value investors are afraid of and many income investors are afraid of. And in our analysis, what we have found is actually, if you just look at the business side of things and return on assets and their volatility, tech stocks actually have a lower volatility and a higher return on assets than other sectors in the MSCI. And that's with big cash piles to boot. So that's on the underlying business performance side. But the stock prices of tech stocks are actually more volatile. They give you better returns, but at a much higher volatility. And that is something that is important to bear in mind. But we see this as an opportunity, particularly in global tech in the US, where people jump out of stocks at the first sign of something not meeting expectations for a quarter. We often pick up these stocks, and it allows us to actually get in and make money on what we think is a reasonable opportunity, because the returns do come through, because the underlying businesses are actually in decent shape. So what that means is essentially patient investors will have higher longer term alpha because it brings through this quality aspect, and that quality aspect means that you get a better quality alpha. So next question, does tech provide any real diversification benefits of including it in your portfolio? And again, here we've done a lot of research, and this is the summary of it, and we've used our machine learning to do this. The correlations since 1999 show that actually global tech in a South African balanced fund provides lower correlation than global equity and South African bonds. So actually, this is a very good asset to have in your portfolio. It stabilizes it with decent correlations. The only other asset class that has better kind of diversification characteristics is actually global bonds. So summarizing kind of the risk and return side, does global tech provide better risk-adjusted returns? Because that's what we're all about. And you can see on this efficient frontier, which puts essentially the Sharpe ratios of different assets added to a South African balanced portfolio, balanced fund, and looks at different percentages of those assets. And what that shows you actually is that, in fact, on the efficient frontier, global tech provides better risk-adjusted returns than both global equity and global bonds. Now, that is something that's very, very important and interesting. So to summarize, why should you include global tech in your portfolio from a portfolio construction point of view? Firstly, global tech is not as expensive as people think it is. As we've seen, you've got to look at it in conjunction with returns and business returns, and those do support a higher valuation. Secondly, it brings a quality and growth bias, and these styles have outperformed over time. There are times, obviously, when value outperforms, but quality tends to be persistent, and this is very, very important. We don't just see tech stocks as a growth story. We see it in some instances in the correct stocks as a quality play, and this stabilizes portfolios. Third point is it brings in significant diversification benefits, and you've seen that adding it to your portfolio gives you lower correlation to both global equity and South African bonds, asset classes that we often use as fund managers to stabilize portfolios. So tech actually adds a lot of stabilization into a portfolio. And this is something which flies in the face of a lot of thoughts that people have had in the past, that tech is risky. Yes, in an absolute perspective, tech is more volatile. But the way it works in your portfolio is a different story. And that's what we're trying to point out here, is that tech within a portfolio makes a lot of sense. Finally, and this is probably the most important point, on a risk-adjusted basis, you get better Sharpe ratios from tech inclusion into your portfolio. And this is particularly in South African balanced funds. And again, what it means is if you're looking for risk-adjusted performance rather than just absolute performance shooting the lights out, which is something income investors would obviously be interested in, well, then this is something that should be included in portfolios. And this is quite an important, if you want to call it, epiphany for investors, because there's often these conventional held wisdoms where people think, okay, tech is risky, there's lots of failures, and including it just increases the volatility of your portfolio. What it ignores is that tech has also actually evolved. And the type of tech stocks you can buy are very different to the 90s kind of internet explorer type of stocks that you saw at the time. These have become like, in many instances, like railway or engineering stocks were in the early stage of the Industrial Revolution. This is very, very important. It adds value from a risk-adjusted perspective to have tech stocks in your portfolio. And at Sentio, we essentially are style agnostic, but we're using these tools of machine learning and AI to actually help us find these global alpha opportunities, to kind of defy some of the myths and the conventional wisdoms that just exist without any data or information to support them. We actually test and question these things, and when you do that, you start finding interesting ways of actually adding dimension to your portfolios. So this is what Sentio is about. I will now hand over to my colleague Olwethu Notshe, who will take you through the case study of Texas Instruments, which, as I mentioned, will bring to life a lot of what I've been speaking about, but on a stock-specific basis.
Good day, everybody. My name is Olwethu Notshe. I'm one of the directors at Sentio Capital. As my colleague Mohamed has alluded to, Sentio espouses ethos of being style agnostic in the way in which we construct portfolios. What this means is that regardless of the style that's in vogue, we aim to outperform the market throughout the cycle. We're going to go through a case study now, which again is going to highlight this style agnostic feature of our culture. We're going to talk about Texas Instruments and why it can be used in growth and income funds. And at the end, we're going to talk a little bit about some of the other quality tech stocks that have made it into our portfolio. Essentially, Texas Instruments is very well known for the calculator that you see on the left-hand side, which is CFA sanctioned. But the business is a lot more than just that calculator. In fact, the calculator is a very small part of the overall business. What they do is they produce semiconductors that you can see next to that calculator. And these little gadgets go into many varying appliances globally. They're present in automobiles, present on factory floors, and present in consumer products. So what this means is that this business, because of its large, diverse portfolio of products, it actually generates very, very stable cash flow profiles. And what this ultimately means is that it generates very good yields for investors. So the answer to can tech stocks be yield plays is definitely a yes. If you look on the left-hand side, you can see a graph with a histogram and a red line. And essentially those graphs, that graph indicates all the semiconductor companies that operate alongside Texas Instruments. You can see, looking on the left-hand side of that graph, that the businesses at the lows produce free cash flow margins in the 20%, and at their highs as high as 35%, where Texas Instruments operates. What this means is that a lot of this money finds its way ultimately to investors' pockets, as you can see with the red line, with a cash flow yield of on average 4%. Over the past 22 years, you can see on the right-hand side, the dividend per share of the stock has been rising significantly. In fact, it's been rising at 19% CAGR over the past 22 years. And again, this highlights the good yield features of these companies, in particular Texas Instruments. So our fundamental process, just by way of recap, is anchored on three questions. The three questions are: what are we saying about a particular company? What is the market saying about a particular company? And what is management saying about their own company? And where there's disagreement in the answers that you get from these three questions, therein lies the opportunity to make a profit. So what we're saying about Texas Instruments is that in today's day and age, the automation of vehicles, the automation of factory floors, 5G, and the rise of fringe computing provides significant growth potential for this company. If you step into a standard car nowadays, its heads-up display has got graphics everywhere, there's sensors all around the cars, and there's cameras. All these components are produced by these semiconductor companies. With the way in which the world is going now, you currently have about $200 of sensors in your average vehicle in terms of penetration. That is set over the next 15 to 20 years to double to $400 per vehicle. What this means is that the cash flow profile and the dividends that investors in this company are set to receive is set to continue to increase. There's also the positive benefit that a lot of this technology is quite old. I mean, semiconductors have been produced since the 1970s. And as a result of this, a lot of the machinery that makes these semiconductors is very cheap to attain. And what this ultimately leads to is that these businesses can generate returns on equities in excess of 80%. And that is where you currently find Texas Instruments. Ultimately, what this means is that the free cash flow yield of these businesses is transparent, consistent, and dependable. And these are great features, again, for income investors who don't have the stomach to tolerate some of the high risk tech stocks that you can find out there. Our second question that our fundamental process anchors on is: what is the market saying about a particular stock? And essentially, the market has been doubtful of the long-term growth rates of this company because of how old some of these manufacturing techniques are. What this has meant is that a lot of these companies are priced to actually have a zero terminal growth rate going into the long-term future. And of course, we've just shown that with the advent of 5G, the Internet of Things, the market is clearly incorrect on this assessment. Secondly, the market has concerns about the cyclicality or the variability that you can find in the earnings of this business. And if you look on the graph on the left-hand side, you can see that, again, the market has been slightly wrong on this because since 2014, the level of volatility of the cash flows of these businesses has been declining and is set to stay at these modestly volatile levels going forward. So again, we disagree, and therein lies the opportunity to profit again. Finally, you could see in the short term that there's a lot of investors that are shying away from these companies because they're adding capacity to meet the semiconductor shortage that we've seen as a result of COVID. A lot of investors don't want to be funding this capex, but we think that given the disciplined approach this management team has had over the past 2 decades, they will invest our capital wisely, and as a result will generate returns that are better than cost of equity on our behalf. Finally, what is management saying? Management have obviously highlighted and have seen the semiconductor crunch that we've been going through over the past couple of years. They've decided to capitalize on this by increasing the amount of capacity that they have on their factory floors in order to produce more and more of these chips. What this ultimately means is that they plan to start growing at double the rate of global GDP. And what this ultimately is going to mean is that they're going to drive cash flows and ultimately dividend yields for their investors going forward. They're adding a capacity to their product lines where they've got competitive advantage, and essentially this is the product lines that they call the 300 millimeter wafer product line. What this means is that they're able to produce these chips at greatly lower costs going forward, and obviously anchors them at the low end of the cost curve to outperform some of their peers in the semiconductor space. These guys have been doing this over the past 2 decades very successfully. If you look at the top right-hand side, they have had $80 billion to allocate of investor money. And just under half of that, they've allocated to R&D and CapEx and SG&A. The other half has actually made its way back to investors' pockets. Just to give context, $79 billion is currently half their market cap that they're currently trading at. So this is a significant return that's available for investors, again, in the long term, if they continue to execute in this disciplined fashion that they've been executing over the past 2 decades. So ultimately, or in summary, how does Texas Instruments rank in the S&P relative to the S&P peers? You can see that they rank in the top 10% of companies when it comes to free cash flow yield. They rank again in the top 10% when you look at how much cash returns make it back to investors' pockets from their sales. And ultimately, they're in the top 3% in terms of return on capital that they produce from their investments. What this means is that you can be very certain that the cash flows that you aspire or think that you're going to receive from these companies is ultimately going to make it into investors' pockets. And what this means is that you are able to calculate value for this business using very simple techniques like discounted cash flows, for instance. We do look at this company from a multitude of angles where we use multiple valuation techniques, multiples-based approaches. And given all those angles at which we look at this company, we're very comfortable to suggest that there's at least 36% upside available in this investment. There's also a significant amount of dividends that ultimately is going to make it to investors' pockets in form of dividend yield, and there will be a significant amount of share buybacks as well. So in summary, this case study has shown us that tech stocks can suit a multitude of different investors. It's not just for growth investors. Income investors also can profit from some of the secular trends that we're seeing in the tech industry. Not all tech stocks are these very expensive high PE multiple businesses that conventional knowledge says they are. They can appeal to income investors. They do provide significant risk-adjusted returns. And again, what this does is it diversifies the risk of a portfolio and also allows for superior risk-adjusted returns to be achieved in the portfolio. They do add an element of quality and growth exposure as well. And as we move into the next slide, again, you'll see some other quality opportunities that we've identified that we've invested in our portfolio. On the left-hand side, you can see Intel, again, another stock that is set to benefit from the increased penetration levels of laptops as a result of people working from home and increased laptop usage in education and in the student population. Apple, another business, again, that is set to also see significant increase in its valuation as a result of the increased amount of services business that it's getting involved in, which comes at superior returns on equity. And finally, Qualcomm, a business that is going to profit from the advent of the metaverse. A lot of the devices that we're going to be putting in our heads have got a Snapdragon platform, which drives the computing power of these VR headsets. So, to summarize, you can see on the left-hand side that is a list of our funds that have got some of these exposures in them. We've got our suite of Sharia equity funds, general equity and balance funds, and on the top of this table you can see some of the platforms on which you can access some of these funds and ultimately some of these opportunities that we've touched on in this case study. Thank you.